Hey, social media family. Today I'm going to talk about a pretty complex topic, but it's going to dictate the future of decentralized finance in the crypto communities. Today, let's talk about perpetual swaps or intro to derivatives. This is going to be a pretty complex topic, but I feel like it's really important to understand derivatives in terms of the crypto markets and more specifically the narrative of decentralized finance or DeFi for short. Let's begin. So, There's there's the derivative markets, which has two tools. Futures contracts and perpetual swaps is what I'm going to talk about. They're both used for leverage and risk management. Perpetual swaps, in particular, are an important market in the cryptocurrency space as they represent the most liquid avenue for exposure to crypto. Perpetual swaps often trade 3 to 10x the daily volume of spot markets. The popularity of perpetual swaps is no surprise because you can have massively leveraged positions, such as a 100xer. This gives traders an opportunity to earn huge rewards, but this also means increased risk exposure. Now, what is derivative contracts? Derivative contracts are basically an agreement that derives the financial value from the performance of a specific financial asset or an index. The common types of derivatives are future contracts and swaps. A future contract is a standardized agreement to buy and sell a quantity of an asset at an agreed price for a future delivery date. An example of that is let me buy 5,000 bushels of, let's say, corn to be delivered next month at a price of $5 a bushel. The buyer of this contract would pay the price and receive delivery of the corn, and the seller would receive the price and be obligated to deliver the correct quantity and grade of corn to a permitted warehouse or shipping station. This could be another example could be you ordering running shoes on Amazon. You order one pair of running shoes that are $200, and Amazon is saying they will send you the correct quantity and the correct shoe to you. Now, standardization is important when we're dealing with future contracts. Making sure both the buyer and seller agree on the quantity, quality, and delivery date improves the liquidity needed to bring together large buyers and sellers. Each of these agents would need to individually negotiate the core terms in it if the market isn't standardized, which will lead to a fragmented market. In crypto language, future contracts represent fungible tokens as the equivalent. So fungible tokens is what you're going to trade with. In practice, many future contracts are financially settled right away in the difference of values between the contract price and the market price on the settlement date. In the case of a physical delivery, the asset exchange is typically another contractual right. For example, the warehouse receipt or shipping certificate. So in Web 2 world, like for example, let's if we're dealing with corn futures, then you have to think about the rules of delivering corn, which the Chicago Board of Trade, for example, listed out. Basically, which districts are allowed, what time, what rules, what area geographically defined by the borders in terms of receiving shipment or shipping corn. So, with this being said, why would people use future contracts? Well, for leverage. On a centralized future exchange, a trader can deposit 3% of the total value of a contract. This means that compared to regular crypto exchanges, they range from 5% to 1%. The amount deposited to secure the obligation is known as a performance bond or a margin. ETFs and investments can hold up to 90% of their assets in treasuries and deposit the remaining 10% as margin in future positions. You also get preferential tax treatment. For decades, the USA taxed gains on futures at a blended rate, 60% on gains and 40% on short-term gains. This tax treatment can make a SPY future contract an attractive alternative than holding SPI straight up, SPI as a spot straight up. And there's no need for access to the physical markets. To trade physical commodities, you're going to need to have a relationship with a clearing bank and a healthy balance sheet. It's also difficult to negotiate fair terms in a foreign exchange market as well. So this allows you to bypass those. How have future markets evolved in crypto? Well, traditional future markets were soon replicated into the crypto space. For example, the March quarterly expiration cycle means that contracts would terminate at the end of each March, June, September, and December. Traders would need to roll their positions by closing out the expiring month and opening a new position for the following quarter. A trader wishing to speculate on the price of Bitcoin could buy one Bitcoin worth of March futures with the cash selling at the March expiration date. This means that the trader would receive the same profit or loss as holding one physical Bitcoin, but paid in US dollar. If the trader still wanted to have exposure to Bitcoin, he would need to buy to June or September and incur the trading costs again. So in BitMEX, which is a perpetual swap futures company, they released their first perpetual swap contract on Bitcoin. Since then, perpetual swaps have been extremely popular. As of now, it's a $32.5 billion market. And for example, derivatives accounted for 46.7 billion, and total derivatives were 23 billion. This is taken from CoinGecko. So a swap in the derivative market or a swap in a derivative contract allows for parties to agree to exchange the two different financial instruments. Decided to make the term of the swap perpetual, which means that there's no expiration date, unlike traditional futures. These two components to a perpetual swap indicates that the exchange of assets being swapped are consistent. Traders can open a new position, such as a long or short Bitcoin against the US dollar, and they can keep it as long as they like. When the future market is in contango, or when future months are trading at a premium to the spot market, traders who are long the futures or perpetual swaps pay interest as they are borrowers of the US dollar. How is pricing the swaps keep in line with the spot market? The futures market should not trade above the cost of carry because of arbitrage. A clear example is the physical commodities market. If oil tanker capacity is available and futures are trading at a premium to the storage costs, energy traders can lock in a risk-free profit by purchasing crude oil in the spot market, selling the futures contract, then holding the oil in storage. So why why even discuss this? Well, it's to show that the different tools that are allowed in the crypto markets, such as perpetual swaps versus futures versus spot. Futures allow you to have similar trading costs and leverage to perpetual swaps, but with the difference that the funding cost is known in advance. This is compared to a fixed or floating interest rate when borrowing. If you use derivatives to go long in Bitcoin, you either buy futures or perpetual swaps. If you buy perpetual swaps, you pay an unknown amount of funding during the holding period. If you buy futures, your cost of leverage can be calculated by taking the difference between the spot and the future and calculating the day to the expiration date to arrive at an annualized funding rate. And then the next option is the spot market, which is you have the custody of the asset rather than a claim on the cryptocurrency coin. So knowing these tools are important when you're dealing with the crypto markets. And I believe these tools will allow you to understand how the DeFi space is improving upon traditional finance by allowing traders to get access to tools that are usually reserved for people with large networks. So this is leading to a decentralized and a downstream effect on the tools that are typically reserved for people who have excellent relationships or big banks or really wealthy individuals who allow these different types of derivatives that are only allowed to them. However, now in the crypto markets, they're being allowed to the common man. As always, these are extremely difficult tools to play around with, and they can lead to total wipeout of your accounts if you're not careful. So do your due diligence, make sure you're trading appropriately and with risk management, and you can utilize these tools. Thank you guys for watching.